Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Brad Smith alongside Madison Mills. Let's get to the three things that you need to know today.
First up, U.S. stock futures holding steady ahead of trade talks this weekend. The negotiations coming after the U.S. announced its first major trade deal with the U.K. this week. Bank of America saying stocks were correct to rally on the trade optimism, but warned the rebound is likely over as investors, quote, buy the expectation and sell the fact. President Trump's tariff announcement in early April triggered the worst stock sell-off since 2020. But since the tariff reprieve on April 9th, the S&P has rallied 14%, though it's still down on the year.
And here's what we can expect from the weekend's U.S.-China trade negotiations. The Trump administration is weighing a dramatic tariff reduction during weekend talks, with Bloomberg reporting that the U.S. has set a target of reducing tariffs below 60% as a first step. However, this morning, President Trump posted on Truth Social and said he thinks the tariff rate should be brought down to 80% from 145%, but is ultimately leaving Treasury Secretary Scott Bessent to make the decision.
And on the earnings front here, shares of ride-hailing app Lyft rallying this morning after topping Wall Street expectations and expanding its buyback. Analysts were positive on the results, with Goldman raising the stock to a buy rating. Meantime, shares of the travel company Expedia plunging as the company cut its full-year outlook as travel demand slows due to uncertainty around consumers' discretionary spending in the United States.
U.S. stock futures are steady following optimism over the U.S.-UK trade deal, with all eyes on China trade talks this weekend. President Trump saying to, quote, buy stocks ahead of the talks this weekend. But is this a buy the rumor, sell the news event? Joining us now to discuss, we've got Brian Vendig, MJP Chief Investment Officer here. All right, so this is the second time in 5 months, essentially, maybe less actually, considering the inauguration at the end of January, that we've heard the president specifically either say or post on social media to buy stocks. What is the investor signal that they should actually be kind of paying attention to as we go into more talks this weekend?
Thanks, Brad. I think what investors really need to focus on are companies that are being clear and deliberate with how they're managing their businesses and how they're focusing on profitability moving forward. I think right now, when we look at the way earnings have gone, they've exceeded analyst estimates. The outlooks have been murky, and as a consequence, I think investors really need to focus on those forward valuations and how much they're paying for growth. Because right now, we're not out of the woods. I don't think it's necessarily a pound the table time to buy stocks per se. It's more of a jump ball right now for the markets to understand where these trade negotiations are going to go. The rhetoric over the course of this week from the administration has been more positive and forward-looking, talking about many trade deals that are going to happen over the next 60 days. That's what the market needs to hear. In the short term, I think still defensive positioning, thinking about the yield curve, being short duration on bonds is also something that makes sense, and being balanced between growth versus value, though growth stocks look a little bit more attractive, considering they've been taking a brunt of the disproportional punishment this year relative to coming into the year with higher multiples than other parts of the market.
And so what do investors do then, especially if the market more broadly is pricing in tariff relief before we actually get it, before we even hear of a lowered rate with regards to the U.S. and China? Then what happens to markets if that's the case?
Madison, that's a great point. I think if we start to see, again, more gradual progress on tariffs and those levels coming down, because as a friendly reminder to viewers, if you add up all the tariffs that were announced and then now are on pause, we were at levels that go back to 1901, and that is not where our economy is, with an effective tariff rate around 28.5%. So I think the process that supported those tariff announcements, I would say, was probably not the most strategic. Now those are being worked out. If that happens, then I think we're in this window where the economy has been damaged, but not permanently. And that's a good news item for investors, so that these concerns about recession over the next 12 months or so start to come down. I think then risk appetites increase. And you look at areas in the equity complex, such as mid-cap stocks, small-cap stocks, more cyclical focused stocks and industrials and financials all catching a bid, knowing that economic growth is still here for the balance of the year, just more at muted levels.
Yeah, I can only imagine in 1901 what they would have done with the likes of Google search engine, or what they would have done with the Shein or Temu to cut down on some of their, fast fashion costs. All that considered, and just aside, Brian, I wonder, what is the checklist, the investor checklist for actually seeing a good trade deal versus one that just feels like it's packaged up and promoted as a big win?
I appreciate that question very much, Brad, because let's be clear, the 10% tariff that is on imported goods, that's not going away. I think that's a minimal level that's going to remain. I think what investors need to realize is that China is going to have its own path that's going to be a little bit more elongated, and it's going to take a little bit longer, I think, to get to a strategic balance. However, other parts of the world that will follow, possibly the EU, India, Japan, these are things that we need to see come down to effective trade tariff levels, somewhere between 10%, 20% on average, I think, to feel a little bit more comfortable. But the biggest risk is time. If these things don't happen appropriately or efficiently over the next 60 days, the biggest risk to the U.S. economy, not only the psychological concerns around demand, but it's also inventory levels. And we've heard recently about Port of LA, the lowest level of Chinese imports and other goods coming in and just sitting there yet to be distributed because of the tariff concerns. Inventory levels in the U.S. supporting consumer demand is something to really keep a close eye on, Brad and Madison.
So if there are any rallies off the back of any announcements with China, obviously the president posting this morning that we could see a rate of 80%, but ultimately it's up to Treasury Secretary Scott Bessent. If we do get that lowered rate and we see a market rally heading into Monday, would you fade that rally?
I think in the short term, the answer is definitely yes. I mean, we have a more defensive positioning in our portfolios right now, but I would say we added to equities a couple of weeks ago when we saw valuations were a little bit more attractive, and also taking a view that we thought that trade negotiations would play out over the balance of this quarter. So right now, we're kind of holding steady. And I would say for investors that have not participated in the market rally, we still have enough back and forth that's going to happen over the next 2 months as we get to that July 8th termination date of the 90-day pause, that there's going to be opportunities to buy good stocks at attractive valuations. So I would say don't give up on the equity markets. And I would also say on the fixed income market side, rates are still elevated. Rates still look attractive on the short end of the curve. And that's probably a good place to be as well, just to be a little bit more defensive.
When you have this much of the institutional money that is cautiously optimistic, but expressing much more of the vocality around the volatility that they're anticipating, the potential downside risk, versus where some of the inflows have come in from retail investors, how do you kind of counterbalance or make sense of how that money is sloshing around, and ultimately, if that means there was a move to the upside, that we would have to see some type of short covering from some of the other institutional money that's knocking around? Well,
anytime you look for trends in the market over a very short period of time, Brad, I would just say the results are random. Mm-hmm. And right now, I think investors just need to be deliberate and purposeful with their portfolios, thinking about how much risk appetite are they willing to digest relative to their longer term goals. And in the short term, this volatility is not going away. Just as we saw earlier today with a couple posts from Trump, talking about China tariff rates, the market can move off of headline risk right now. And I would say the market's probably trading more on technicals and those headlines. I would feel a lot more comfortable in how asset flows are moving around if we get through this period and we get into July earnings with some better outlooks, because then I think you can be a little bit more deliberate on where you want to allocate from a risk perspective. And that's just our view right now, where we're in a little bit of a wait and see.
Brian, thank you so much. Really appreciate it.
Thank you.
Well, U.S. officials will meet this weekend with their Chinese counterparts in the first known talks between the two nations since widespread tariffs were announced. The meeting comes just after President Trump unveiled the trade deal framework with the U.K. Trump teasing, quote, many trade deals are in the hopper on Truth Social this Friday morning. But our next guest flagging 3 reasons not to get too excited about the prospect for more deals. Let's bring in Charles Myers. He's Signum Global Advisors Chairman and CEO. Charles, it's great to have you here. Just talk to me about the biggest thing to watch when it comes to these China deals, especially off the back of that UK framework. Does that make you a little bit more cautious about the likelihood of us getting some hyper-optimistic deal with China that can make investors pretty optimistic on Monday?
Well, I think first, the White House has created, I think, an expectation that there may be some major breakthrough with China this weekend in the talks in Geneva. And I think, this is that we may get a few positive headlines on we're making some progress, but any deal with China is going to take months, if not even a year, to get done. I think the good news, though, and what's being discounted in the markets in a positive way, is that there has been progress on trade. I think the UK trade deal is certainly a sign of that. And I think that most of the news on trade incrementally from here is net positive. Again, it's going to take longer to get to some of these deals, but I think that the markets have been right to be a bit more optimistic on the direction of travel of the negotiations broadly and progress being made with several countries.
I'm interested in that, Charles, because we were just speaking with another guest who said maybe the market is already pricing in trade deals before we even get them. To what extent are you concerned that investors are trading on something that hasn't even happened yet and, to your point, could take a lot of time?
Yeah, look, I think that the market sold off so aggressively on Liberation Day, and with the announcement, the president and the White House then had to do probably one of the biggest climb downs or U-turns within 13 hours of the tariffs going into effect, primarily because of the bond market. The Trump put is in the bond market. It's the 10-year and the 10-year yield. It's not in the equity market. But everyone went so bearish, and I think what was underestimated was, in fact, how serious this White House is, and Scott Bessent also is, at really making some progress on trade from here. So while it will take longer, perhaps, I still think the direction of travel is positive. And secondly, we can now pivot to the next big story in the markets, which is tax cuts and deregulation. I think people were just too bearish. I also think people were far too bearish on the risk of recession.
There's also the spin that we're going to hear from all countries that are negotiating deals. Who needs a deal more between the U.S. and China right now, from your analysis?
Well, I think the United States really needs it. The U.S. is on the back foot on this, given the amount that we import from China, with tariffs at 145% or 85%, wherever we land, even in the short term, is incredibly painful for the United States, both for inflation, for supply chain disruption, and for recession risk. So I would say that it's very much in the interest of this White House to get at least to get to de-escalation with China, if not working towards the framework of a deal.
If the U.S. is on the back foot then, in terms of negotiations, you never want that, obviously. So why would China be incentivized to make a deal with the U.S. under the conditions you just laid out? And given those headwinds, can we expect to hear a lowered rate under that 145% level to come out of this weekend's talks?
Well, I think China, it's in both countries' interest to de-escalate and try to get to some kind of trade deal. I think where we ultimately land with China is probably somewhere between 20 and 30% tariffs. So not the 10% that will be universally applied to everything else coming into the U.S., but probably somewhere between 20 and 30. I don't think that'll be announced this weekend. I think this weekend is about really setting some ground rules and also a timetable for further negotiation. But it is very much in both country's interest to de-escalate this as soon as possible, and I think China's there. The issue with China, just quickly, is they're not afraid of the U.S., unlike some of the other countries that actually really are concerned and want to cut a deal quickly. China can play the long game, and they're not afraid. So again, tougher negotiation, but in both countries' interest to de-escalate.
Charles, I wonder how much this trade deal, if we see one come through, whether that be in the coming weeks, months, year, as you've even put on the table here, how much that just looks like the same phase 1, phase 2 trade deals that we saw in 2019 and 2020, where that essentially still had 25% tariffs on the table, and then $250 billion of Chinese imports, 7.5% tariffs on about $120 billion of Chinese imports.
Yeah, I think it'll look, some of the tariff level will look around the same. The improvement is that China will actually honor, as part of any upcoming trade deal, the terms of the phase one trade deal under Trump, which was to buy U.S. agriculture, machinery, et cetera, which they've reneged on. So I think that's an easy win as part of this broader negotiation. At the end of the day, Beijing has already signaled that their economy can absorb 20% tariffs from the U.S. Without, basically what they're doing with stimulus and other. I think we'll probably land between 20 and 30, so quite similar to phase one, but again, with China honoring the terms.
Charles, great to have you here with us today. Appreciate the breakdown and the analysis.
Thank you for having me.
Coming up on Morning Brief, everyone, we count you down to the opening bell on Wall Street. Plus, we sit down with the CEO of Lyft as the company beats earnings expectations, and Expedia cutting its forecast for the year amid a slowdown in U.S. travel. We'll discuss that and much more on Morning Brief. Now time for some of today's trending tickers. We're watching Pinterest, Expedia, and Taiwan Semiconductor. First up, Pinterest soaring after reporting strong first quarter revenue and issuing better than expected guidance. The social media company's second quarter revenue forecast easing concerns of an advertising slowdown. Executives say the company's ability to leverage AI, artificial intelligence, is a key differentiator there. The shares, they are moving higher by about 10%. We're seeing moving higher just after the report by 15%. And ultimately here, as we continue to think about what this means for the advertising market and where Pinterest plays a role in that, I think they're carving out quite a good space and leveraging some of the artificial intelligence features that they've been talking about for a few quarters to really bring on more of those ad dollars as well.
Yeah, the company being able to swing to a profit here and guiding for higher than expected revenue going forward, but there is a question mark here, of course, due to none other than potential trade-driven policies, specifically given potential headwinds in Asia, a large portion of their advertising coming from Asia. They could be pulling back on spending, according to a Bloomberg intelligence analyst talking about his reaction to the print, having said that the monthly active users, the revenue, and the EBITDA all coming in better than expected. And this is also one of my favorite, I like to call them girly pop stocks, where you take a look at what the girlies are spending time on, and then you tend to see the stock going into a positive reaction. So that's just my personal favorite indicator. What are the Gen Z girlies using? They're using Pinterest.
I mean, that's exactly what they said. The CEO, Bill Reddy, had essentially said that Pinterest appeal among younger demographics. Pinterest is where Gen Z goes to shop.
Right,
is what they said.
Exactly. There you go. All right, let's get over to Expedia. Another look at the consumer, cutting its full-year outlook as U.S. travel demand falls. The online travel agency's first quarter results and second quarter outlook also missing estimates. The CEO warning that weaker than expected demand is continuing in their current quarter. Really tough in terms of demand in the U.S. They say it was softer than expected, and 2/3 of the company's business comes from the U.S.
Yeah, taking a look through some of the outlook, the guidance that the company had offered as shares are down by more than 10%. The company looking to see gross bookings between 2% and 4% here in the second quarter of 2025. Revenue growth, that's expected to be in this range of 3 to 5%. And there is a lot of caution, it seems, among analysts, but still, you've got this range of price targets. Top side, $290 still remains, it seems, and then the downside there, $143. So it is quite that range that you're seeing, at least from this point where Expedia is currently trading at $151. And of course, as we get into trade, we'll see exactly where things continue to shift towards. The CEO saying that they did deliver results within their guidance range this quarter amidst softer U.S. travel demand. So having to acknowledge what some of the macro trends are that are playing out as well.
Absolutely.
Also, Taiwan Semiconductor's revenue jumping 48% in April as customers rushed to buy chips before tariffs took effect. Still, the recent surge of the Taiwan dollar could pressure the chip makers' margins going forward. Since most of its business is done in U.S. dollars, just taking a look at shares, they are up by about 2.5%. And this really speaks to some of the onshoring of those chip products prior to and looking to beat some of the kind of tariff implications that everyone was trying to wrap their minds and their business operations around.
Yeah, and given the strong demand that you mentioned leading to that 48% revenue jump here, obviously that is potentially a boon for the likes of NVIDIA, and we are keenly awaiting their earnings print coming up here on May 28th. Taking a look at TSMC shares up over 20% for the month. And you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. And coming up here, Coinbase's quarterly results falling short of expectations as the company feels the effects of volatile swings in the price of cryptocurrencies. But with Bitcoin back above $100,000, could next quarter see a boost? Joining us now, Devin Ryan, Citizens Director of Financial Technology Research. Devin, great to have you. So Bitcoin back above that $100,000 level. To what extent do you continue to see the price of Bitcoin impacting crypto stocks like Coinbase?
Hey, good morning. Thanks for having me on. So it absolutely matters because it affects sentiment on the group. And so the first quarter was, obviously a little bit of a risk off as the quarter progressed, and you saw crypto prices coming down a bit. What you've seen just over the past, a little bit over a week here at the beginning of May, crypto market cap's up over 10%, and you're seeing pretty strong re-engagement in trading. So a little bit of a lighter trading quarter in the first quarter for Coinbase. Second quarter has started also relatively slow. April with the tariffs kind of risk off month, and then the tone here just even in recent days has been quite a bit better. So we're looking for kind of a better second half of the quarter relative to the first half. And then the bigger picture here is Coinbase is focusing on what it can control and really building out a much more diversified business model that we think can last through kind of crypto volatility over any short period of time.
What do you think is the largest growth engine for their business right now, Devin?
Well, today it's still trading, but what I would say, and this kind of gets lost, I think, in some of the noise, is that the subscription and services part of the business, which is nearly $3 billion run rate right now, is again, it's about a third of revenues. It didn't even exist 5 years ago. So you now have a $3 billion business, and that part of the business is going to grow rapidly. That's where they are helping Circle, their partner, expand stablecoin utilization. We expect stablecoins are going to grow by more than 10x by 2030. So kind of an explosion there and a big opportunity, staking and then crypto kind of as a service, where Coinbase is really, as more people come into this ecosystem, which is happening now, but it's really going to happen on the other side of stablecoin legislation and market structure legislation. Coinbase is going to be in the middle of all of that, whether it's tokenization or helping firms get into the industry. And so that's going to be a big future opportunity for Coinbase. It's not, it is growing, but it's not moving the needle as much as it will in the future.
Yeah, and you mentioned in your note that management is still hopeful on legislative progress going forward. But of course, as you know, there was a bit of a scuttle to that this week when Democrats did not move forward legislation that is GOP-led that would be favorable to cryptocurrencies in particular. Are you concerned about that legislation leading to a broader headwind for cryptocurrencies, or do you think this is just a bump in the road?
Yeah, so great question. We're obviously watching closely, but our sense is right now this is more negotiation and the path is still forward. So there's just been such bipartisan, I think, support over the past really 6 months as people realize this is a critical issue for the American public. It was a key kind of winning point for the past election that we just had here, and not just at the presidential level, but across Congress. And so we think that we're still moving in a positive direction. We're watching it closely, but I think that kind of the vote yesterday was just more negotiation tactics relative to some big halt in progress.
And so what would holders of crypto truly like to see in not just the establishment of the strategic Bitcoin reserve, but actual either purchasing or adding to the pile that already exists of excess of 200,000 Bitcoin, which I believe we're still the largest country or nation holder of Bitcoin right now?
Yeah, so I think there's two things. There's obviously Bitcoin, and Bitcoin, kind of this digital gold asset that has been growing kind of through the ups and downs of the market over the past decade plus. And I think that is something that people feel very strongly about continuing. And then you have kind of added fuel to the fire, whether it's the strategic reserve or the ETFs, which we think are still in the early days and will have much more demand over the next couple of years. And then now you have all these corporate treasuries stepping in as well. And so that, in our opinion, will support much higher prices over time. And so I think people are looking at that tactically, either from a trading perspective or just they own Bitcoin and they're going to hold it for a long time as digital gold. The flip side is you look at all these other tens of thousands of digital assets, they're serving very different purposes, some of which we think have a very bright long-term future as a blockchain that will be utilized, and some are much more speculative. And I think what we all want to get to is a place where we see the utility of the blockchains, and that's going to drive value over the long term.
Devin, good to see you. Thanks so much.
Thanks.
All your markets action ahead and the opening bell. You're watching Morning Brief.
That's your opening bell this Friday morning on Wall Street, looking at the New York Stock Exchange and the NASDAQ on your screen. But let's get you a check of the markets to open up the final trading day of the week here. It's going to be interesting to see whether or not some of the market gains that we have seen over the course of the last 48 hours are able to hold throughout the weekend here, because you've got your S&P 500 up about 0.4%, your tech-heavy NASDAQ up about 0.5% here. And what's going to be interesting is whether or not any of the headlines that we may be getting over the course of the weekend on any potential trade deals with China are going to be able to lift this rally further. Taking a look at some of the sector action, as you can see, a lot of green on your screen here. Energy really one of the only major laggards this morning, and we've even got tech moving to the upside, so definitely a risk on sentiment. The big question, are investors going to sell the rally if we do get any trade deal news coming into Monday? Let's get to Yahoo Finance's Jared Blickery for a broader look at what's moving. Hey, Jared.
Thank you, Maddie. I want to go back to the major indices, and I've been tracking all of the majors that have been stuck under their 200-day moving averages. I'm going to dig into this in the 10 a.m. hour, but suffice to say, we're just kind of in a holding pattern right here. And until we break to the upside, we do still face a possibility of heading down back again and maybe testing these lows that we had in early April. So that's kind of what's on my mind there. Besides that, we have the newest AAII Bulls and Bears survey. Now, the Bears have been in control for 11 weeks straight, and that is a record according to my calculations here. And so that's something I'm keeping in mind too, which actually might be a little bit of a positive, and I'll cover that in the 10 a.m. hour as well. Now I want to jump to the 10-year T-note yield, because that is on the way down. It's only a basis point here, but it did touch a 2-week high earlier, and we can see trading to the downside there. And then the U.S. dollar also backing off a little bit, but it also had a huge 2-day surge, and earlier this morning it hit a 4-week high. So what's interesting to me is that yields and the dollar are just moving a little bit in tandem again, and that was not happening over the prior few months when we were having all the tariff problems. So maybe this kind of signals some kind of change, some kind of regime change in the markets. That would be a potential welcome sign for the bulls here. Back to the sector action. Don't need to go over today's because Maddie just did that, but I want to show you the 5-day. We have cyclicals leading. Industrials and tech each up over more than 1%. After that, we got energy and consumer discretionary, communication services, financials. That rounds out the top row. Healthcare had the biggest tumble this week and had some problems in biotech earlier, and we can see that's trading to the downside about 1 or 3%. Also, real estate down and staples and materials. So the defensive sector is taking the brunt of the bearish forces today, which is a bit bullish. Now, here's the NASDAQ. This is also a 5-day look. So I just want to point out that NVIDIA and Tesla are actually about tied right now, both up almost 3% for the week. But let's get a check on what's happening in the day here, and also look at Alphabet. Alphabet down 6% after that tumble earlier in the week on the news that Apple was going to be instituting some AI into their search bars to complement Google. Now, this is what's happening today. Tesla up 4%, Apple up 1%, only Alphabet trading in the red there. And for the most part, kind of, I'd say a little bit more green than red, not seeing too many outliers, so not a lot of volatility in the market this morning. And I do want to get to the futures market just on energy. Energy was leading today, but guess what? That is on the backs of crude oil, which has had an interesting 5-day price reaction. You can see down a little bit off of the highs, but for the most part, pretty bullish throughout the week, up over 5.5%. And then in the context of the year-to-date price action, you can see a little bit of a rounded bottom forming. And I should note that these were some of the lowest prices that we've seen in 4 years. So this could be an important bottoming formation for crude, but too early to call that right now. I'm going to leave us on crypto. Crypto has had an amazing couple days. Bitcoin surging past 100,000, touched 104,000 briefly. These are the highs over here back earlier in the year, 107,000. And Ethereum just blowing it away, up 19% over the prior 24 hours. That is a huge surge. finally broke out of this negative trend line here. So it looks like crypto might be leading the risk rally to higher ground here, but we don't want to get too ahead of ourselves. Back to you, Brad.
Jared, thanks so much. Setting up today's trade in action very well here. Appreciate it. It's time now for today's strategy session. Persistent inflation and tariff uncertainty, putting investors and the Federal Reserve in a tricky spot. So what does the Federal Reserve do next? Joining us now, we've got Kathy Jones, Charles Schwab Chief Fixed Income Strategist here. Kathy, great to see you. Thanks so much for joining us here. So I wonder, as you're kind of reading through what we already heard from the Fed this week and what that could do for the fixed income portion of investors' portfolio, how should they be kind of balancing the curve?
Yeah, thanks for having me. Well, I think the Fed is trying very hard to do nothing and making that clear. So they're still waiting for clarity. They're still waiting to get closer to their goal of lower inflation and hold on to the employment outlook. And for them, they're caught in a hard place here, because the tariffs could certainly push up inflation. And if that inflation becomes persistent, then they have a problem on the inflation side. And then, we have the potential for tariffs and retaliation to reduce employment. So tough spot for the Fed. In terms of investors, we think that the best spot to be right now is in sort of the middle of the yield curve, stay up in credit quality, stay 5 to 7 years on average duration. And that gives you enough yield to compensate for, waiting. You're not caught if the Fed does cut 2 or 3 times this year. Then if you're too short, you're going to have reinvestment risk. You're going to miss capturing some of these yields. You go too long, then you're caught in the turbulent news flow on tariffs, and you get a lot of volatility. And if inflation does pick up, the long end's going to be the tough spot to be. So we kind of like intermediate duration. We want to stay up in credit quality because there is a risk to the economy and lower credit quality sectors of the market if tariffs cause a big slowdown in the second half.
Kathy, wanting to stick on where you see investors finding the most opportunity across the yield curve, specifically with regards to the 10-year, obviously seeing some continued strong demand when it comes to the 10-year auctions here. But given the administration's interest in keeping yields on the 10-year as low as possible, do you still think that there's opportunity there for investors?
Yeah, it's fine for the administration to have a goal to keep 10-year yields down, but they have to effectively make that happen through policy, right? And right now, policy is pushing yields a little bit higher. We also have the budget to consider and what the deficit's going to look like, what spending's going to look like, et cetera. And that all feeds into the term premium and the 10-year, that risk premium that investors need to hold longer-term bonds. So on the 10-year, if we get much above 4.5, 4.60, I would probably look at that pretty favorably, all else being equal, as a place to start extending duration. It could rebound to 5%. That's not our base case, but it's a possibility. But I really wouldn't be overweighting 10-year and beyond at this stage of the game until you see how the economic data plays out after we get a little bit more information on tariffs.
And with that in mind, whether tariffs actually lead to persistent inflation, and depending upon the size and timing of that pass through here, that's one of the considerations to try and figure out what the longer term inflation expectation also looks like here. And so all that considered, how does that influence for the Fed that's looking for a trend in that data dependency, how aggressive they might be about their cutting?
Yeah, they really can't cut right now. Inflation expectations are rising, and that's something they've really put a lot of focus on. So the New York Fed consensus expectations was out yesterday, and that's been ticking up for the last couple of months. And that's a very bad sign. You could dismiss maybe the University of Michigan survey and a few others, but most of the surveys now indicate inflation expectations are starting to rise and a 3% or above, and the Fed's aiming at 2%. So that's a bad direction for them. And then you have the potential for tariffs to actually lift prices and maybe cause persistently higher inflation. So there's nothing they can do as long as unemployment is still low. if inflation and inflation expectations are above target and even trending higher, there's nothing that motivates them to cut rates at this stage of the game. So those inflation expectations may be even more important right now than the actual inflation readings, simply because that's something the Fed puts a lot of focus on.
Kathy, thank you so much for joining us this morning. Appreciate it.
Thank you.
Let's take a look at one stock we are watching at the market open here, and that is Texas Roadhouse. Shares are higher, up over 5% after the company posted mixed earnings for the first quarter with lower than expected earnings, but a 3.5% increase in same-store sales. On the earnings call, leadership acknowledged some of the macro headwinds, including consumer sentiment and, of course, tariffs. The comments echo concerns voiced by other companies like McDonald's, which said they were not immune to industry volatility. Chipotle on its call saying consumers reduced restaurant visits due to e-com concerns. Joining us now on this, John Towers, Citi's restaurant analyst, to break down how consumer demand is impacting the sector. John, it's always great to get your insights. Before we get into the individual companies here, I just want to get your macro take on the sector and on the health of the consumer. How would you describe how the consumer is holding up amid the macro uncertainty right now?
I think fairly well. I mean, we had a really noisy first quarter with weather really being a significant factor, and then March, and then April came along, caused a lot of noise for consumers. Confidence fell quite a bit during the month, and I think that caused a lot of folks to pull back, at least temporarily. But we're also hearing from a number of companies that April actually improved relative to what they were seeing, certainly during February, March. So it's a bit of a mixed bag. I'm not all that concerned on the health of the consumer at the moment. And look, I don't know where we're going to go from the U.S. economy standpoint, but if we do go to a slowdown, I think the restaurant category is actually set up relatively well to outperform other parts of consumer discretionary.
When you hear this number of businesses talking about remaining focused on the fundamentals of our business, things what they can control, what are the main controllables, the variables that are a little bit more in their hands that they can essentially kind of pull levers here and there to ensure that they do navigate what is an uncertain environment that all of them have acknowledged in some capacity or another?
It's great value, great service, it's relevant products, it's staying in front of the guests with good news, meaning, you're staying out there with important or relevant products, right? You're not just saying, here's a value price point, it's here's a value price point with new product news behind it. And it's high quality food, right? And you're getting it in an environment that you want to be in. It's not a tired restaurant with poor service. It's, frankly, a waiter or waitress coming up to you and saying, hey, how you doing? And I hope you're having a great day. And oh, by the way, we're coming to your table more often to make sure that your drinks are topped off. You're getting what you want. It's really those soft touches that will drive customers back to the store rather than, eating at home or going to a competitor. So I think all of those, it's really soft things, but they matter in times when consumers are pulling back.
And so within that, some people will hear value and read through to say, well, it sounds like more promotions as well. To what extent then do some of those promotions start to hit the margins?
Yeah, I think a lot of the operators have gotten smarter about how they promote, when they promote, and value engineering any sort of promotion that they put forth to the guests. So it's not just straight discounting, it's ensuring that whatever they put forth on their menu, they're making some profits, not only clearly for the company itself, but in a franchise model, ensuring that their franchisee profitability is not, falling in the tank. So everything that you're going to see out there might, decrease profit dollars modestly, but they're also hoping that it drives traffic to the store. And then when a guest comes through, they're adding, say, a beverage to the occasion, adding a side item that they wouldn't have done had they not come to the store in general. So it's much more thoughtful than it used to be, say, even thinking back to the financial crisis when there was a lot of panic setting in across the industry and there was just straight discounting to get guests in the door. This is a much more methodical industry, much more analytics behind it. So I do think that as we see promoting come through, more discounting come through, it's not just straight up discount, unprofitable. It's more thoughtful and profitable promotions.
John, thanks so much for taking the time here with us today just after the opening bell. Appreciate it.
Good to see you. Thank you.
Likewise. Coming up, a conversation with Lyft CEO David Risher when Morning Brief returns.
Lyft shares driving higher after the ride-sharing company reported better than expected gross bookings for its first quarter. Lyft's results a contrast to rival Uber, whose gross bookings fell short in the most recent quarter. Here to discuss Lyft's results is CEO David Risher alongside our executive editor Brian Sozzi. David, great to speak with you. Thank you for making time for us this morning. It's really interesting to look at your results, especially when compared to your competitor Uber here. What do you think that Lyft was able to do over the course of the quarter and over the course of your several years here now as CEO to outrun your competitor?
Obsess over our customers. It's just that. You know, I worked for Jeff Bezos for a long time, and he really taught me the importance of looking super closely, figuring out exactly what your riders and drivers, in our case, want, and just really overdoing it to give it to them. And our service levels have never been better. We're doing all sorts of great things for drivers. I'll give you one statistic. We now have a 23 percentage point advantage over the other guy in terms of driver preference. And that's because we treat drivers well and they deliver great service.
David, one of the things that we've continued to track across the travel industry, and especially in our conversations with airline CEOs over the course of this quarter and results, is the uncertainty in their outlooks and how that could potentially be passing through even to the ride sharing is something that investors I know have been paying close attention to. What are some of the trends that you're seeing just around those hubs as it's kind of passed through to the Lyft business?
Yeah, you know, it's so interesting. And of course, everyone's very interested in this, and I understand why. The truth is, we haven't seen anything to be concerned about. And I'll give you a couple of examples. Let's look, for example, at our last week in March. It was our best week ever in terms of ride volume. Let's look at Cinco de Mayo, which just happened just last week. Super strong, really nothing going on there. Even airports, I mean, it's true, as we said last time, you know, airports been just a tiny bit on the softer side, but honestly, it's so small as to be almost negligible. And of course, in our business, the bigger question is, you know, how can we get, right now only about 20% of people take rideshare to the airport. Where are the other 80%? So I'm more focused on the big opportunity right there. Honestly, haven't seen much to be concerned about in terms of consumer sentiment.
David, good to see you as always here. Like Brad was mentioning, look, the economy slowed down the first quarter, but it's still a competitive market for talent. Really curious on what you think about, you know, a lot of the feedback, to say it lightly, that Dara at Uber's getting for getting his employees back to the office 3 days a week. And then secondarily, what's your return to work plan?
Sure. So hey Brad, good to see you. I, joined in this seat a couple of years ago, almost 2 years and I think 2 weeks ago. And one of the first things I did is told our employees that we're going to be back in the office 3 days a week. So, you know, we've really been ahead of this. Our focus has been on really obsessing over customers. And as you know, I mean, our purpose is to serve and connect, And it's really hard to do that if you're all sitting around, you know, sort of being isolated at home. I have all sorts of things to say about societies when they get isolated. I don't think it's very good for society. And I think it's great for business when you get people back in the office. So that's what we've done.
Well, clearly, I mean, it seems like you're gaining the competitive edge against your other guy, as you mentioned. Do you want to go to 5 days a week? Do you think that really helps you go farther ahead of what Uber's doing? I mean, they had 2 days, David. Why not go to 5 and really take it to them, man?
You know what? I don't think that's what we're going to fight over. I think, look, I'm going to do a pivot. This is what CEOs do. And I'm going to talk about a new feature that we've just launched called Lyft Silver, which is all about getting older folks, you know, out and about and making sure they live their best lives. That's the type of feature that you really get when you obsess over your customers, when you focus on what it is that they want. And, you know, whether you do it 3 days a week or 5 days a week in the office is sort of secondary to really focusing on what it is your riders and drivers want.
Well, I think back when you first started, David, I think we talked to you pretty much right when it happened. You had to make a lot of tough decisions out of the gate. Would you just simply say, it is what it is? Or do you have to have now in this environment, you have to have more compassion for your workforce?
I think you have to have some compassion for your workforce. I really do. Look, here's something that we know. People do their best work when they feel supported. People do their most creative work when they're together bouncing ideas off of each other. But honestly, people also have complicated lives. They've got kids to deal with. They've got babysitters. They've got moms they've got to, attend to as they age. So, I think we've got the right, it's a hybrid strategy. I think it works really well for us.
I want to go back to a little bit of the balance sheet here, Brian, because David, sorry, because one of the things that you point out that I think is really interesting is the obsession with the customer. And part of the way you've obsessed over the customer is keeping prices low to eke up market share from your competitors. How do you continue to do that in an environment that's increasingly competitive and increasingly hearing from analysts that they want you to continue pouring cash back into the company through things like the buybacks you announced versus keeping prices lower for customers?
Yeah, it's not a trade-off. You have to do both. You have to do both. And so again, you have to start with the customer. And I'll give you an example of something that we've done. We've talked about it in the past, which is price lock. Price lock is a way for any rider who wants to, who does a daily, kind of commute or something that has the same route over and over again, to lock in a price. So they don't have to deal with all the surge pricing baloney that somehow the rideshare industry has convinced people is okay. We don't think it's okay. We're trying to get rid of it as much as we can, and that's our mechanism. That's a product that's increased every single quarter since we've launched it. We have very high retention rates, 75%. So really good growth there. So that's an example of how you can do right by your customer, give them an affordable product, and in this case, a reliable product. And at the same time, as you mentioned, Madison, we generated $920 million in cash over the last 12 months. So we figured out a way to do both, and that's going to be the way we continue to grow as a business.
David, I was just at the Milken conference out in California, and I was walking back to the hotel with an $8 Starbucks coffee, and out passes me this Waymo driving past me with nobody driving in the car and somebody in the back. I'm like, well, that is some weird stuff. I mean, why are you launching autonomous vehicles in Atlanta? Does the world really need this stuff?
Does the world need it? Well, okay, it's a great starting point. Are you building technology just to build it, or are you building it because people actually want it? Here's what I'll say about autonomous vehicles. They're going to be an enormously important and I think positive addition, to sort of our transportation infrastructure. Why? Because they are safe. Not only do they know the rules of the road, they follow the rules of the road. And over time, that's going to just expand the market for people being driven by something else. Sometimes drivers, sometimes robots, fine. As you said, we're launching in Atlanta in a couple of months with our partner, May Mobility. Super excited about that. Honestly, it'll be at a small scale. You have to step into this. This is going to take years and years and years and years to kind of get right and to get great. But I'm excited about it. I think it's actually going to open up new opportunities. And at the same time, I have to say, there are a lot of people who are going to want to be driven by, a great driver who maybe helps with your luggage, maybe even asks you how your day is going if you're having a tough day. So I'm kind of excited about the sort of hybrid future of autonomous and human drivers.
David, only got 30 seconds here, but for the operating cost per mile for Lyft's business in the future, when you expand this and scale it up, what does that look like in terms of bringing that cost down?
Well, are you referring to autonomous or more generally? I mean, we're always looking. Yeah, sure. I mean, of course, like any business, we're trying to lower our costs. When you think about autonomous, you might think, of course, that the cost will be lower because you don't have to pay a driver. On the other hand, insurance is a bit of unknown. Repairs and maintenance are a bit of unknown. So, of course, if that happens, we'll be excited about it. It'll allow us to offer to more people. But it's going to be years out before I think cost is really a significant part of the equation.
David, thanks so much for taking the time here with us today.
For sure. Enjoyed it. Thanks, y'all.
Brian, thanks for joining for the conversation.